In this video, guys, we're going to look at the pros and cons of using a stochastic trading strategy. Stay tuned. Hey traders, warm welcome to you. All right, so pros and cons of using a stochastic trading strategy. You could substitute that for RSI, you could substitute that for CCI. Any kind of oscillator is really the same type of strategy. So all we're looking for here with oscillator is, and make sure you've kind of looked at some of the other videos if you're interested in this kind of topic. We've talked a little bit more in depth about the intricacies of actually how to pull the trigger and some different ways to use those oscillators as well. But the pros and cons are pretty clear actually. And what we're generally trying to do with an oscillator is we're trying to sell in an overbought condition and buy in an oversold condition. And it's a mean reversion type trade. Even if you're using a trading environment, by the way, and you're waiting for a pullback to an oversold condition for a further pushback up to overbought, you're still trading mean reversion even though in a trading environment. It's a little mean reversion trade within a trend trade. But let's go back and keep it simple for now. Overbought condition, we're going short or we're taking off our long. Oversold condition, we're buying. So what are the main drawbacks of doing this and what are the positive things of doing this? Let's hit the screens, look at a few examples and see for ourselves. Let's go. All right, guys, so the main thing, let's just bring up something very simple. A currency pair, because I know that our currency's super popular and this really kind of highlights the issue with these. So let's just clear up this chart a little bit. What I'm going to do is I'm going to show you a kind of standard chart. So let's just put on a daily chart, and with stochastics we use any kind of any oscillator. So stochastic, RSI, CCI. What I'm going to use a standard stochastic on the standard settings, and just kind of for information purposes, guys, on TradingView, which I'm using here, you've got 14, 3 and 3. So the idea with your stochastic is that, let's get rid of the VWAP, don't need that. The idea of stochastic is overbought condition is here, oversold condition is here. So you're looking to go short in overbought and long in oversold. So the pros of this are that in the right conditions, it's a very, very good strategy for timing the highs. For example, let's look at this scenario here. Let's look at this section. So put a vertical line in and say, right, from here to here, we're kind of range bound. That's a decent kind of month period. So we've got a high here, overbought condition, that denoted the high. Then we came down to an oversold condition, that was the low. Then we pushed back up again. So not quite an overbought condition, but this really went overbought here. And yes, there's a bit of news and spiked off, but you can see very narrowly how then a range bound condition, if we go to a kind of a larger range, it's quite good at picking the highs. The highs there, you got a high there and overbought. You have to sit with a bit of heat there, low. You got a high here, just almost overbought, not quite, low oversold. You get the idea. Okay, so it guides you reasonably well. It's not foolproof. Nothing is foolproof, as we know this. There's always some downsides to stuff, and you can even see if you're too early in it, you get hurt. Now, that's the pro. It keeps you on the right side of the market. It stops you perhaps shorting too early. Let's say you're waiting to short, or let's say you're waiting to buy this, for example. You can just wait and wait and wait until you get to oversold conditions and then buy. And like I say, there's ways that we can time it with the crossover, etc. That's up for you to kind of fine tune. However, let's look at some of the cons of trading with stochastics. And it's a big one straight away, is that really when you get into an oversold condition, you're in this unusual situation, which is very often the case with mean reversion, guys, is that, and regardless of what strategy you're using, you're in an oversold condition, and let's say you're, and I'd never recommend just using purely overbought or oversold on its own, because you'll see why in a moment. But the more the market gets oversold, the better you think the trade is. And of course, in this scenario, this one we've just literally just scrolled to end of April, mid-May, GBP USD, 1 day chart, a daily chart, pushing lower, oversold. It stayed oversold all the way from literally end of April right the way through to the end of May. So you were sitting through all of this before eventually it turned back up. And by the nature of the stochastics, because it's related to previous days, it's now reset itself almost, if you like. This stuff becomes irrelevant depending on the time frame you've got it, depending on settings. All this becomes irrelevant, and it's now looking at this area here as opposed to anywhere before. And so a little slight push up almost pushes into overbought territory. And then especially as you go further on, you get, you know, literally how far we've come from here to here, you're now overbought. Well, that's pretty useless for you if you've been buying it way back here in the first oversold condition. You're still significantly offside. So the serious downside to using it is that the market can stay overbought or oversold for a long period of time. And the secondary downside to that kind of stems from that is that it looks worse and worse and worse. You know, if you liked it oversold here, in theory, you're going to love it when it's really oversold here, and it looks even worse and worse and worse and worse. And then you're in a trap, because do you hold it? Do you add to it? Well, you shouldn't add to it, because this is just a normal kind of move. If we had a real extended move, in fact, you know, if we go to one of the classic ones that always springs to mind from many years ago, which was this yen breakout. Whoops, let's just put this back on there. You know, this yen breakout. You know, we broke out from here. This is the kind of down channel from a long time ago. We broke out very aggressively, moved higher and higher and higher. You know, we're overbought here, guys. We're overbought at 105. Give it the benefit of the doubt, 106. It went to 118. Before it finally rolled over, and by the time it went oversold, it was 112. So you are getting hammered with that. So the point is you've got to be very, very careful. And it's one of those things that lulls you into a false sense of security, because here you're selling highs. Let's say you're aligning yourself with this downtrend and you're selling highs. It works very nicely. Overbought. It's timing those 3 or 4 highs or 5 highs almost perfectly. And the next time you do it, you're getting hit. So you've got to be very careful about that. The obvious way to manage that is to use stops, even if you're using some sort of wide stop. And one way of doing it very quickly, guys, a trick to do this is to say, okay, what's the distance from the last overbought to oversold? So there's my overbought here, there's my oversold here. Okay, what's the distance of that? Just look at it eyeball, 400 pips. So let's say you're swing trading for a longer term basis. Right, I'm going to use a 400 pip stop as a worst case scenario. So that means you're not getting completely annihilated. Now, bearing in mind 400 pips sounds like a lot to a lot of people, but if you're swing trading and kind of grabbing these as 1,000 pips just in that move. So it's all put into perspective. And of course, if you're on a lower time frame, it's on a lower time frame. So guys, the summary is, pros of using it is it keeps you patient to wait the overbought condition to go short, waits for the oversold condition to go long, stops you going in too early. If you're too early, maybe it can play part of a trading strategy. Don't think it's something you can use really on its own, just very, very strictly using it, but it's quite good as a filter. So that's a pro. It keeps you on the right side of the market, keeps you from chasing stuff, because you're never going to be going long an overbought condition. You're always going to be literally buying on red, selling on green, which overall isn't a bad way to position. The con, the big con or downside is that as the market moves in your favor and it pushes higher and higher and higher, moves in your favor as in the stochastic goes overbought, so it's your favor waiting to go short, it can stay overbought for a long period of time. One, not so good, and two, the market looks better and better and better. So you must have good risk reward management strategies. Like any indicator, guys, there's pros and cons to it. They're useful in the right environment, they're useful under the right conditions. Oscillators can be very powerful if used right, but just be careful about some of those things and getting caught out by them. Right, guys, take care, keep the risk manager, whatever you're doing, it's the key to everything. Take care, bye-bye.